Right, what we're going to look at now is F9 Financial Management Past Paper Analysis. If we were to consider F9 and look at the past papers that have occurred, what we may be able to do is to get some idea of maybe what's more likely to arise and what's less likely to arise. More than that, we can get some feel for which of those 8 syllabus areas is more important and is less important. The first thing I'd like to point out to you, if I may, is in overall terms, after analysing all of the papers to date, the split between both discussion and computation is almost 50-50. What I have is that the discursive or written components of the exam are 52% and the computational components are 48%. Given that when you're looking at some questions, it's debatable whether it is discursive or computational, particularly where you have a number of different ways of scoring maximum marks, this to me is 50-50. What does that mean to you? Well, of course, what it means is that you cannot pass this paper on computations alone. A lot of people try to do that, and it's a very foolish idea. It also means, from my perspective, that when you're looking at the paper, there are often situations where there are tricky computations. Yes, you get so far and then you're stuck. And a lot of people spend far too much time and mental effort trying to get the last bit of the computation out where there must be some easy discussion marks. So, split somewhere near 50-50. If we were to look at marks by syllabus area, I think we get some very interesting information. You have to bear in mind, of course, that in an individual paper, there could be considerably more or less marks on a syllabus area. But what I've done here is I've prepared an average mark, just to get some idea of the relative importance of each area. Very interestingly, if you look at the first 2 syllabus areas, financial management function and financial management environment, you see that on average they really do have very little bearing on your ability to pass or fail this paper. Financial management function, 6% on average, 6% of the marks. What this basically means is that there's going to be one question of 3 to 10 marks, normally on a theoretical aspect. And if you think that's not much, if we look at financial management environment, on average, 1 percentage point has been covered in this area. And again, I suppose what it reflects is that when we look at the financial management environment, it's the background. It's the background within which everything else is examined. Now, of course, you have to be slightly careful with this analysis because there are a number of times where it's relatively easy to allocate marks to one area when they could have been in a number of different areas. But what we're saying is, yes, you need the background, but you don't expect a very substantial mark allocation from it. Then we look at the next 3 areas. Working capital management, on average 22%. That was a surprise. When I put these numbers together, I hadn't appreciated how important working capital management was to your eventual score. Then we have investment appraisal. Again, 22%. I don't think that's much of a surprise to any of us. That is the big topic, or should I say now, the equal big topic. Then we have business finance at 19%. Well, I don't think that should be a surprise. Your examiner has highlighted at Examiners Conference this very fact. He was criticised at Examiners Conference for going and looking at business finance again and again, and he simply turned around and said, as far as he was concerned, it's a fundamental area and he is going to keep on revisiting it. And if on average 19% of the marks are coming from that area, well, he is revisiting it on an almost consistent basis. Then cost of capital, WACC and things like that, we've got a 12% weighting, and business valuation also 12%. So these are relatively less important, relatively. Having said that, you'd be a fool if you were to ignore them. And then finally, we've got that problematic subject of risk. And here, the mark on average has been 7%. But I think some of you may have detected a trend in the paper, because what has tended to happen is that we have got risk every December sitting, but not in the June sitting. Now, I'm not guaranteeing that at all, but effectively what that's saying is that in the December sitting, we're getting something like 15 marks on it, and in the June sitting, we're having virtually nothing. Okay? So this is the sort of analysis that you can look at. And of course, statistics is always a way of hiding things or overemphasizing things that maybe you shouldn't do. So I'm just going to keep it very simple. That gives you some idea, I hope, of the relative importance of the sort of subjects within this paper. This session is where we look at non-discounted cash flow methods of investment appraisal. In particular, we focus on payback and ROCE, or return on capital employed. What we want to look at here are non-discounted cash flow methods of investment appraisal. Now, to call it non-discounted cash flow methods is possibly not very helpful, because you may not have come across the idea of DCF, or discounted cash flow. Suffice it to say, what we're looking at are the more basic investment appraisal methods. Now, given that we're looking at them, what I want to do is I want to use the same example for a number of different questions that we're going to look at. I suppose this is a typical investment appraisal example. Rayner Limited has the opportunity to invest in an investment with the following costs and returns. So we have an initial investment of 100,000, and typically that occurs now. Now, what I mean by now in time terms is this. It occurs in what we say year zero terms, because that is now. We are standing at the end of year zero. If you wish, tomorrow is the first day of year one. So, the initial investment we will talk about later as being year zero terms. And then we have cash flows, and for the sake of ease, we typically say that they relate to the end of each subsequent year, although in practice they probably don't. So at the end of year one, we have an inflow of 50,000. The end of year two, an inflow of 40,000, and 30 and 25 and 20. And then we have a residual value in year 5 of 5,000. Presumably we dispose of the asset and we get some cash back for it. We're also told the cost of capital is 10%. Now, we don't need that to begin with, but of course we're going to use this example for a number of different questions later on, and as such we have that there just in case.